It's 600 points, 15% in 2 months. If you think it's smart right now to go long after a 15% run in 2 months, well, then the trade is not the smartest PX, it's the dumbest PX, because I'm not as dumb as I look. Make trades when the market gives you an opportunity. Right now, after this stupid, huge, long up move, it doesn't make sense. Hello, everyone. Uncle Tony here. Today, I have a special treat for everyone. So I'm going to reveal a trading plan, my own personal trading plan. Of course, please, this is not advice. This is not a recommendation. This is what I do to run my own money and how I allocate capital, how I plan results, and what expectations I have of my own trading every year, how to make money. So I encourage everyone to use this as an educational video. And of course, everything I say here can be tweaked to your personality, to your capital, to your risk tolerance. And this is just my personal trading plan that I use to create a 20% return a year using at least 70% probabilities of trading. And once I go into each of the strategies, I'm going to try to refresh everyone the basics of each strategy, the expected return of each strategy, and how much money I allocate to each of the strategies. Alrighty, so let's get to it. Now let's take a look at the trading plan. You know, if you don't have a plan, you don't know where you're going. You don't know what goals you're going to achieve. So it's very important to have a trading plan in order to understand what your capital is, what your possible return is on that capital, what risk you're taking, and how to allocate that capital correctly. The plan that I'm going to show you is my own personal plan. Please. Okay, so let's take a look at Uncle Tony's top secret trading plan. And this is the plan I use for my own money. This is how I take risk, and I hope it helps you improve your trading in 2024. So here, I'm starting with a portfolio size of $1 million. Here, please, you can change it to $10,000, $1,000, $10 million, $100 million. It all depends on how much money you're going to use to trade. In the next column, I see strategy. And here are Uncle Tony's favorite strategies. We can see we have the 12-month put campaign, which is one of my favorites, the 111, the 120, the 112, the Smart SPX, the weekly SPY straddle, SPY strangles, a very beautiful and complex trade, the 488, and very importantly, cash treasuries. Why do I have 25% in cash? The reason is twofold. Number one, what if there's a big opportunity out there that we didn't see at the beginning of the year? I need to have some cash in order to take advantage of that opportunity. And second, what if the market starts going down, volatility starts expanding, and once it expands, you know, the margin required by your broker is going to increase quite a bit. So it's always important to have a lot of cash available so you can have enough money to withstand a big down move or take advantage of an upcoming opportunity. Now, the first two sections of my trading plan is the portfolio allocation and the allocation amount. Let's use the 12-month put SPY as an example. I think this is going to be very useful for everyone. So first of all, I like to allocate a maximum of 10% per strategy. Other people like to trade 100% of their money in one single strategy. Hey, if it works for you, that's fine. Like I said, this is an individual plan. It's an individual recipe. This is how it works for me. So I like to give a strategy $100,000, which is 10%. Now, then if we move over, initial buying power per unit, what does that mean? The initial buying power per unit is the amount of money our broker requires to place one single unit, just one unit of this trade. So for the put campaign, the broker is going to probably ask us for $8,000 of initial capital to place the put campaign. And next to it, it's a very important concept. Like I mentioned before, planned capital per unit. Planned capital is much different than the initial buying power. It is much bigger than the initial buying power because it's the worst case scenario capital requirement. I always like to look at the worst case scenario, just in case things don't go well and the market goes down, volatility goes up, and the broker wants more money. And this is why you see $18,000 as planned capital for each single unit. Now, then we have initial buying power usage. What is initial buying power usage? Initial buying power usage is the initial amount of capital my broker is going to require to put all the units of this strategy that I like to trade, because I don't like to trade one unit only. Maybe I'm going to have 1, 2, 3, several units on. So this is my requirement for the units that I want to have on simultaneously. And the maximum planned capital usage is, in case of an emergency, I want to know how much capital this trade is going to suck up from my account in order to avoid a margin call. If you see the total for initial buying power, 556, this is what I expect to be using all the time in my account. And the 914 amount is an amount in a worst case scenario. I want to keep it because I have $1 million account. I want to keep it under $1 million because I don't want to run into, unfortunately, a margin call or a capital call. The next section, I always like to remind myself where the risk of the strategy lies. In the naked put, the average put that I like to sell is normally around the 16 delta. Then the average credit that I will receive on this trade, it's going to be about $1,000. I like to do 2 units a month. That means 24 units a year. And because I take profits around 50% profit, those are the Tasty Live, commandments. We always take profits at 50%. So I am guessing that I'm going to have 12 units on simultaneously. And those 12 units, if we go back to our initial buying power, those 12 units are going to suck up around $96,000. And in a worst case scenario, they're going to suck up $216,000. Then we're going to see what is my annual expected return, which is $1,000 times 12 months, $12,000. And if we see on top here, this is what I expect my portfolio to produce, $15,000 a month and $183,000 per year. Now, that return based on the initial capital is a return of 33% on the capital used to place the trades, and it's a 20% return on maximum risk. And if you see the profit is $183,000, you're going to say, hey, Tony, $183,000 is not 20% of $1 million. Yeah, but remember, I'm keeping a portion of our money in cash, and that's why the return is not 20% on the total. It's 20% of maximum risk capital. And this amount, the 33, the 20, and the 183,000 is a flexible amount. What do I mean? If I'm lucky and I trade smartly and I take advantage of a lot of opportunities that the market's going to give us, I'm probably going to be able to place a trade maybe once or twice in a single month because the market went down. I was able to sell when volatility spiked, then close it. And maybe I do a 1-2-0 on the put side. Maybe I'll add a 1-2-0 on the call side, which requires no capital, blah, 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 etc. So I think I can improve on those numbers, but I like to be conservative. I like to make sense. I like to have a achievable goal, because if we set stupid goals that are unachievable, then we're going to fail at trading. Now I'd like to dive into each of the strategies and remind everyone how to trade each of my Uncle Tony's favorite strategies. And also we're going to do something really, really cool. We're going to use a backtesting software that Tasty Live offers for free. Normally these backtesting softwares, they cost a lot of money. Everybody asks a ton of money to use them, but Tasty provides them for free. So let's get going and let's go one by one on Uncle Tony's trading strategies. Well, let's take a look at Tasty's backtesting software, which is really, really unbelievable. The first strategy that we are looking at in our in our trading plan is the put campaign. What is a put campaign? It's a strategy that we're going to place every month. We're going to be selling puts every month, 1 year out, and we're going to keep them on until we make 50% profit. And let's see if Tastytrade agrees with Uncle Tony. So I like to go to the advanced backtesting because it gives me more flexibility than the basic backtesting. And here I clicked short put, which is a bullish strategy. I'm going to sell just one put, and I like to sell the 16 delta. And I said we're going to do it with a 365 days to expiration. Let's run the backtest and see what comes up. Ooh, all righty. So here we go. Here is the premium that we expect to collect, $337 every time we place a trade. The medium trade is going to be 254, and this trade is a proven winner. And here it has a win rate of 99%. This is what I love this trade. And the largest loss, because I didn't put any stop losses, is $1,500. Now let's modify a little bit our trade. I like to take profits at a 50%, following Tasty Life commandments. Let's run the back test again, taking profits at a 50% probability. So here, take a look what happens. Our largest loss, instead of being a $1,500 loss, it becomes a $47 profit. That means this trade is almost 100% profitable by selling one SPY put a month. What if we do 2 of them? We run the strategy again, and there we go. We have updated the numbers, and I like to use this backtesting to make sure that the trade I'm placing does make sense, and we do profit in the expectations that we want. If we want to change this backtesting to a different underlying, we can put SPX for those of you guys who have a larger account. And let's run the backtest using SPX. As you know, SPX is much larger than SPY. And here, look at the numbers. The numbers go up huge. The profit per trade, it goes to $2,400, and the medium profit per trade is $1,500. So as you can see, it's Tasty is excellent. It allows us to run backtests on different strategies, and you can change the underlying that you like to trade. You can change the size, the delta, the days to expiration. So it's very, very flexible to backtest any strategy that you like. All righty. Now that we've backtested our strategy and we saw it's a solid strategy, and how can we improve on the results of the backtest? You see, I don't like selling puts on an up day. What Uncle Tony likes to do is I normally sell puts on a down day. And by selling puts on a down day, gives me a little extra edge, gives me that je ne sais quoi, a little bit of extra profit that it's going to come very, very helpful in the future. Now let's take a look at the strategies we're going to review today. I'm going to review a little bit fast. Of course, you can pause the video. You can rewatch it again. I don't want this video to be 2 or 3 hours long. I'm going to give you the rules for each trade as Uncle Tony likes to trade them. Of course, once again, you can modify Uncle Tony's rules to fit your own individual risk tolerance or units or whatever you like. But remember, you always have to be careful of the initial buying power per unit, the planned capital, and the maximum money that you're going to allocate to that strategy. And all these monthly expected profits are based on experience. Of course, the backtesting software can help us understand how much money we're going to make. But my experience is also, I think, very valuable. So I already know how much money each of these strategies should yield and provide a profit for me till the end of the year. Let's review now the 12-month put campaign strategy. Let's go to our beautiful Tastytrade platform and let's go. So these are the rules for the SPY put campaign. Number one, we're going to try to go 1 year out. And 1 year out is December expiration. It's almost 365 days. This is where I like to trade it. I normally like to collect around $10. That's me. That's Uncle Tony. And I always like to look at the expected move. You see this brown area here in the Tastytrade platform. This area is showing us what the expected move of SPY is in the next 12 months. So the SPY is expected to stay between $410 and $530. And here's what I go, and I'm gonna hit sell the 415 put. As you can see, we're gonna have a max profit of $995. The max loss, it says $40,000 because the computer is telling me that if the SPY goes to zero, we're going to lose $40,000 for each contract. Of course, if the SPY goes to zero, believe me, this put is going to be the least of your worries. And the buying power effect that the computer and the Tastytrade platform is asking me right now is about 4,179. But if you remember my trading plan, I was planning for $8,000 of capital as my initial, because it was conservative. As my planned capital, I was looking for $18,000. And let me show you why I'm being conservative. If I start to move our put closer to at the money, let's say we go to the 440 strike, take a look at the buying power effect. Instead of $4,000, now it's $6,400. If we keep moving this put to the at the money strike, we're now at $9,400, which is just a little bit above my, my initial buying power. And what if the market crashes and our stock goes in the money? You see, the margin keeps going up, and it's pretty much topped out at $9,600. Why did Uncle Tony put $18,000, which is double what the computer is telling me? Because if volatility expands, the broker will change those margins requirements. And I like to be ultra conservative, and I don't want to lose my shirt. So once again, let's put the trade back. Let's go to 415. Here we go, 415. We're going to collect $1,000. The computer's telling us we have an 82% probability of profit, and we have a 93% probability of collecting 50% of our money, which I love. It has 20 SPY deltas, which is a little bit bullish. We're going to make $3 a day in theta collection. And let's take a look at the trade graphically, because, I'm a graphical person. Probably you guys are as well. So this is the trade, and it's a beautiful trade. And, it's very easy. I like to go month by month. Every month, I look at the $10 put. If the $10 put is at the expected move, then I say yes, check one, check two. I place the trade, and boom. And, that's it. It's a very, very easy trade. It's a very simple trade. And I think you can spend, just a few minutes every month looking at it. And once again, here we are, 12-month put. The computer was telling us $4,000 as a maximum $9,000. Uncle Tony went to $8,000 and $18,000. What does this allow me? It allows me to have more cushion, more capital. And as you see, I'm only planning to use $500,000, which is 50% of the portfolio as initial buying power. And as a maximum buying power, I'm expected to use $914,000. Now let's take a look at the 111 trade. This is one of my favorite beautiful trades. Let's take a look at the trading plan just to remind ourselves. I'm also allocating 10%, which is $100,000. Now the initial buying power for each one of these trades, I'm putting $65,000 and on it, which is significant. And I'm putting a maximum buying power of $90,000. My initial buying power 1. And I'm only planning to do one of these trades a month. If you're a good trader and you get lucky, I've been able to put 1 or 2 trades in a single month by putting it on. The market rallies, I close it, take my profit, then the market goes down again and put it on again. That's why these return on capital can improve a lot if we trade correctly, if we are opportunistic, and we take our money, we take our chances, and take money off the table so we can have more money to invest. Now, let's go to the Tastytrade platform and let's place a 1-1 trade. I like to go 45 to 60 days out. So here we are in the February timeframe expiration. I like to look at the 25 delta. You guys know I always like to buy the 25 delta put. That's one of my bread and butter strategies. Here we go. I like round numbers, so we're going to choose 45.75. We're going to buy this beauty one time. Here we go, and we're going to be paying, as you can see, $34 for this trade. Then I like to go 50 wide, which take us to the 45.25. I'm going to sell that one once. And here's an observation. My short put is already past the expected move, which is something I like. And here we have a debit of $6.80. As you know, Uncle Tony likes to collect around $15, $15 to $20, $13, etc. If we're paying $7 and we want to collect, $15, what trade should we sell? Let's try to see if we sell this one, which is worth $20. I like it, but let me like it a little bit more. Here we are, and here we have a credit of $14.40. This is a maximum profit of $6,400. The maximum profit will only be achieved if we fall into the what I call the trap, or the little circus tent here. And if we fall in this circus tent, you can see that we can make serious money. Also, if the trade starts getting out of the high part of the circus tent, we're still going to be fine. And we're going to break even around, the 4,400 area. This trade has a 91% probability of profit. It has $1,500 of extrinsic, which I love. It has a big chance to make money. It has an initial buying power of $70,000. And let's also go back to the table and move our short put higher. And what happens to our buying power if we keep moving higher? As you can see, it went up now to 75. I'm going to keep moving and moving our put, and all the way to at the money, because I want to see what happens if our short put goes in the money crazy. And how much buying power does the computer or the broker ask me? And here we go. S&P is trading right now at 4,700. At 4,700, the computer is asking us for $85,000. And I think I had budgeted $90,000 for this trade. So once again, I erred on the side of conservatism, and I don't want to go crazy on my planned capital. And so here is the $90,000, one trade. I'm expecting to make around $1,700 per trade of planned capital on this thing. Now let's take a look at Uncle Tony's bread and butter. What does bread and butter mean? Bread and butter means it's the trade that I like to do the most. I do the 1-2-0 as often as I humanly can. And what I love about the 1-2-0 is I like to do it on the put side, and I like to do it on the call side. Of course, the call side, guys, has a naked call. And Uncle Tony's rules, never sell a naked call. I know I've been breaking my rules sometimes, but I'm very, very conservative on the call side. If you are afraid of the call side and you don't know how to handle a huge up move, don't even touch the 1-2-0 on the call side. Just do the put side, and that will help you be, stay a little bit safer. So let's go back to our Tastytrade platform. And here I like to do something different. I like to go first to the expected move. So the expected move here in February, once again, 63 days, is 45.35. So here I'm collecting $28. Since I know I'm going to sell two of those, that means I'm going to be collecting around $53, $54. And since I want to get a credit, I'm going to be looking to buy let's say the 40 put value. And let me see. Boom. Yes, sir. It's $1,600 we're going to collect of extrinsic value. It has 88% probability of profit. And let's take a look at our trade. It's a little bit different than the 111. It's a little bit more aggressive than the 111. But if we end up falling in the circus tent, the amount of money we're going to make is huge. And here is something very, very interesting. The S&P is right here at 4,700. You see the little red flag? If the S&P starts going down little by little, as time passes on, this part, you see this curved part, that circus tent is going to start lifting up like helium. Nobody understands it. Nobody can see it. But trust me, if the S&P goes to 4,600, 4,650, and we have 2 weeks or 3 weeks of time elapsed, the circus tent will lift up and it will make our profit range much, much bigger, giving us a chance to take this profit off for a credit. The ideal situation here is to put on the trade for a credit and close the trade for another credit. That's called a double dip. Why? Because we got money in our pockets when we sold it, and then we get money in our pockets again when we close it. That sounds like magic, but believe me, if you do this trade often, you'll understand how to profit and make and squeeze a little bit more juice out of your lemon. And this is an unbelievable trade. Let's go back to our trading plan. And here, you see, I'm expecting a credit of $1,500. I'm expecting to make $1,700. Why? Because I always like to take it off for a little bit of a credit. So if I collect $1,500 and then I close it for a $2 credit, that's my $1,700. It's a beautiful trade. It has a return on initial capital of 28%. If the S hits the fan, I think I can make 20% on my capital, and it's going to provide me a $20,000 profit a year. If I only do one of these trades a month, normally I do a lot more than one because I'm opportunistic. Like I said, you put the trade on, and then you put it off, and sometimes you're lucky you can do it 2 or 3 times on the same month. Now let's take a look at a trade that my friend Sweet Bobby and Tom Shaw, they all say they came up with this trade, but everybody knows Uncle Tony invented the 441, the original 441. And all these trades, the 441, the 331, the 221, the 111, the 112, everything came from the 441. The 441 was the original trade. It was the granddaddy of them all. And the 112 is a modification done especially by these two great traders, Tom Shaw and Sweet Bobby. And they love to do this trade. And I'm going to show you the rules of the 112 trade. The expected profit, as you can see, is very similar to my 120, very similar to my 111. The only difference is it has 2 naked puts instead of 1. And that's why the maximum planned capital, it's not $100,000, it's $180,000. Because if the S hits the fan, the broker is going to ask us for a lot more money. And here we see a big difference. The 120 normally has the risk on the 20 delta, and the 112 normally the risk is at the 7 delta. So let's take a look at the 112 trade, and I'll give you the rules. So if you want to trade the 112, you know what to do. Let's clear up our 111 trade. Let's go to the trade page. Now the 112 trade normally is traded a little longer expiration, normally around 120 days. So I always like to use the monthly expirations. They have more, of course, they have more liquidity, and it's great. We once again go to our trusty 25 delta, and I like to find the round numbers. So here we go, 4,500. Then we're going to sell a 50 wide put spread that takes us to the 44.50. And here, normally you're going to be, you see $7 right now. Normally you're going to be paying between $7 and $9, maybe $10, $11 as a max. But this is the normal amount that you guys are going to be paying. How are we going to finance this? We're going to finance this by not selling one, but selling two short puts at the 7 delta. So let's go down to the, let's go down first to the 5 delta. And oh my God, the 5 delta is, as you can see here, it's almost at the 2 standard deviation. So we click it, we sell two of these guys. If you take a look at the trade here, we're buying 14500, selling 14450, and selling two 3840s. Yes, sir. 3840s, and we're going to be collecting again $1,800. Our max profit, which will happen, which is this trade looks a little different than the ones that I love. Here, the trap is a very long trap, or the circumstent. The circumstent goes all the way from 4,500 to, almost 3,800. If the S&P happens to land like in the roulette table, anywhere here, we will make $6,700. Yes, sir. $6,700, which is amazing. And why? Because we're going to be profiting. We're going to suck up all the profit of this put spread, the 4,500, 4,550, which is $5,000 profit. We're going to be able to suck up this profit for ourselves and take advantage of this situation. Now, this trade has a little different management than the other two trades. The other two trades are easy. Once you get your credit becomes another credit, you take it off. The 112 is it requires a little more hand holding because it has more moving parts. Let me show you how Uncle Tony likes to handle the 112. So we can see that these puts that are worth $12, they're gonna erode pretty fast. If the market doesn't crash down, these puts are gonna be losing value significantly. When these puts lose, I would say 90 to 95% of their value, that means when this put is worth only $1 or 50 cents, 75 cents, hey, you're gonna grab those puts and take them off. Why? Because there's huge risk happening on those two puts. All the risk is at our naked strikes, and what happens? We're going to be left with a beautiful long put vertical for free. Now, this vertical, you can do a lot of things with it. If the market starts going down and it has some value, maybe it's going to be worth $10, $12, $15. Hey, you can decide and take it off and make more money. You can decide to leave it till expiration and use it as a free lottery ticket. Or you can close everything when you're closing those short puts down. If you get a credit for your trade, take it off and put it on again. Remember, if every time we take risk off the table, it's a win for us because it's another instance on our back testing. It's another opportunity that we have to make money on our money. If you buy an apartment, you can only rent your apartment once. Imagine that this apartment is worth $90,000. If we put it on for rent, we collect our credit, and then time passes and we can close the trade and eliminate the risk. Hey, we're putting that money in our pockets, and then what we're going to do? We're going to put it up for rent again. So that's called speed of money. The faster you can reallocate capital and reallocate risk will improve your, of course, your profitability and your returns. If you guys want to go deep into the 112, my friend Sweet Bobby has a lot of videos, also Tom Shaw, talking about the 112 in depth, and you can go deep into the rabbit hole in the 112 watching their videos. They're very interesting. I just wanted to show you guys what the trade setup is and how I take it off. And the key is size. Keep your size small. Remember, the risk is at the two puts at the end. And when those puts lose value, close them. Doesn't make sense keeping them on. Now let's go back to our trading plan. The next trade that I want to go through with you guys is the Smart SPX. The Smart SPX is a beautiful trade that actually I was hired by some very large pension funds in Latin America. They wanted to have S&P 500 risk on, but with a buffer. What does a buffer mean? It means that they wanted to be long the S&P, but also if it goes down, they want a little cushion. And you see here, this is not a this is normally either a not a debit trade or a very, very small debit. That's why I put it in red, because this trade performs a little different than the other trades. And I want to show you guys how to do the Smart SPX. Actually, the Smart SPX is a very complex trade that starts out with 100 shares of stock, and then we add a long call. And then in order to cancel the bad extrinsic of the long call, we sell 2 calls, and then we do algebra. We convert the 100 shares of stock into a synthetic, blah, 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 blah. So it's a big complex trade. Hopefully someday I'll do I'll do all the algebra for you guys. If you're interested, please let me know in the comment below if you want me to dissect the Smart SPX trade. But like my friend Tom Sosna said, do you want to eat the sausage or you want to know how the sausage is made? I'll probably do a video later on and show you how the sausage is made on the Smart SPX. But for now, I just want to show you how to eat the sausage. Let's go back to our beautiful Tastytrade platform. This trade, I like to do it also at 45 to 60 days. And here, follow my rules blindly. Why blindly? Because we don't have time in this video to go through the algebra. Remember, I'm just showing you how to eat the sausage, not to cook the sausage, or how to make the sausage. So here what we're going to do, we're going to buy the at-the-money call one time. And you see, this is a very, very bad trade. It has $12,000 of extrinsic and only has 38% probability of profit. So let's start fixing this problem of, remember Tony's rules, death before debit. And death before debit means death before extrinsic. So we have to get rid of this $12,000 extrinsic, negative extrinsic value. And the first thing I'm going to do is I'm going to look for something that's 50% the price. So let's figure that this is $130, $125. So half of that is going to be around $65, $63. And hey, what do you know? Hey, I'm going to choose this one because it's a really nice round number. And this vertical, and we're buying the 4,700, 4,800 long call vertical. This trade now, the intrinsic value, it's not as bad as before, but it still has negative $5,000. And the probability of profit increased all the way to 48%. Now, the buying power effect right now is $5,700, of course. It's much lower than my planned capital. And in order for us to eliminate that $57, what I'm going to do is I'm going to sell the 4680 put. And now we have a positive extrinsic value. Now we have a trade that has 57% probability of profit, and it has a buffer to the downside. What is the buffer? The buffer is the distance between our long call and the point where we start losing money, which is the 4680 put. And here you go. Here is a look at our chart. It's a beautiful looking chart. Now let's take a look at our beautiful Smart SPX chart. So here we are. Here is the Smart SPX, and it has a small buffer. The reason the buffer right now is quite small is because there's no volatility. Let's check the VIX right now. The VIX right now is at 12. It's hitting yearly lows, which is crazy. This trade, of course, if you want to be opportunistic, you have to do it, especially when the VIX is a little bit higher and on a down move. Remember, be opportunistic. Make trades when the market gives you an opportunity. Right now, after this stupid, huge, long up move, it doesn't make sense to place any of these trades right now. It really, really does not. Take a look at the SPX chart. Do you think this is a good place to get long? You know, in October 27, we were at 4,100. Now we are at 4,700. It's 600 points, 15% in 2 months. If you think it's smart right now to go long after a 15% month run in 2 months, well, then the trade is not the smart SPX, it's the dumb SPX, because I'm not as dumb as I look. I don't think I'm going to be placing any smart SPX trades until I see a little bit of a pullback. So we've all heard, Warren Buffett. We've all heard Warren Buffett talk about wait for your pitch. The best baseball players in the world wait for the right pitch to go swing for the home run. Looking at this chart is not giving me the vibes of a sweet, beautiful pitch down the middle that I can hit out of the park. Right now, this market is overextended. The market thinks the Fed's going to cut rates. That's why it's flying. It's killing all the shorts. All the shorts are covering like a thief in the night. And this is not the time to do the smart SPX. The smart SPX is not smart. It's actually dumb SPX if you put it on right now. And excuse my language. I tend to be not politically correct. And so right now, I just wanted to show you how to do it. And how do you take this trade-off? You take this trade-off two ways. One, if the market rallies and your short put loses a lot of value, you take the short put off and reduce the risk. And the other way you take it off, let's say the market ran up absolutely lunacy, like crazy. Then if the market ran up a lot and it went past your short strike of 4,800, maybe you can take off this long call vertical, this 100 wide vertical for $90, $95, which is almost max profit. And then you take your $9,000 profit, you put it in your pocket, and you thank Uncle Tony because, this trade made you a lot of money in 1 month. And guess what? Because the market runs up a lot every year, we have months when the market runs up huge. And those are the months you're not going to make $1,000, $2,000, $3,000. You might make $10,000 in one of these trades, and then you're going to be super duper happy. If you see, I'm planning to make an average of $3,500 per trade. And how am I going to achieve that? In some of these trades, I'm going to make $1,000, $2,000. Some of them are going to make $9,000, $10,000. But with the experience that I have trading this all the time, I expect to make $3,500 on my trade. Now, the next trade, like most of these trades, some of them I came up with them by myself. Some of them I've taken from other super smart traders. And the weekly SPY straddle was given to me by one of my best buddies, the PM collection, Antonio. This is for you, my friend. This is one of the most beautiful trades we do every week. I like to do it every Wednesday. Some people like to do it on Monday. Sometimes some people like to do it on a Friday. Now, if we have 3 straight up days, I might wait and not do it on a Wednesday because you know me, I like to do it on a down day. And this is also a campaign trade. The monthly SPY is a campaign trade, and this is a campaign trade. All the other trades are not really campaign trades. What's the difference between a campaign trade and an opportunistic trade? A campaign trade is a trade you place every week or every month, no matter where the market is and what the market is doing. And a opportunistic trade is a trade you place on a beautiful down day when the VIX spikes up and we have a chance to put it on for a better price. Let's take a look at a weekly SPY campaign. Why SPY? Because I like to do a 3 lot of these trades, and if I start doing 3 lots on SPX, then I'm going to run out of money really, really fast. So we go back to the table. I also like to go 60 days out. Here I'm going to sell. Here I'm going to sell the straddle. We click on the bid on both sides. And normally with experience, you'll know you're going to collect between $15 and $22 for the straddle if you sell it 60 days out. And here I like to take out 25% of the credit received. As you can see, this trade has a 50-50 probability of profit. And if we are collecting $18.63 and I want to keep 25%, that means when this trade is worth $14, I'm going to take the trade off and collect my beautiful, you see, I'm going to collect my beautiful 25%. That's plenty beautiful because it's a weekly trade. I like to place it every Wednesday. Uncle Tony likes to place these trades every Wednesday. So it's a campaign trade. And, put it on, take it off. How do you manage? Here you see, I'm planning to have 6 of these trades on simultaneously. What normally I place 3 trades on 1 week and 3 trades the other week. And normally by the 3rd week, I'm already taking profits on one of my SPY straddles. And how do you manage this trade? Of course, when everything's going well, you don't have to do anything. You put on the trade for $18.63. When the trade is $14, you put a GTC and it closes automatically. But unfortunately, the market doesn't behave rationally all the time. The market moves. We've all heard the market moves. And what happens, let's say if the market runs up huge, and if the market runs up huge, what we're probably going to do is we're going to delete the put that we sold, and we're going to probably have to maybe even go inverted and sell a put higher to protect this trade. And that way, by moving our put higher, what we're doing is we're moving the circus tent more to the right. And now we have an inverted strangle on, but we're protecting the right side. The more you move it to the right, the more you're going to protect your in the money call. And what happens if the trade moves to the other side? If the trade moves to the other side, what you're going to do is we're going to move the call in the money further and further to the left in order to protect our 469 put that we sold. So you see, you have to be flexible. You take profits on the side that you made money, and then you sell it out again, but inverted, deep in the money, so you can protect yourself if the market goes against you, unfortunately. And here you can see that I had the call. I'm selling the call further down in the money right here, and this trade will protect us from the downside. This is how it will look if the market starts crashing down. We will take profits on the call, and we start moving it down, 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 and in order to protect the 470 put that we have on. You see, the beauty of Tastytrade, it allows us to see how the circus tent that I call, behaves when we start moving things around. So that is a beautiful, unbelievable, gorgeous campaign trade. Once again, the campaign trades are the weekly SPY straddle and the 12-month SPY put. And now I want to share with you Tasty Life's bread and butter strategy. It's a beautiful strategy. The only caveat is it has a naked call component on it, which we have to be a little bit more careful, a little bit more wary. We have to be smarter. We have to be similar to the weekly SPY straddle. We have to quickly adjust and move the losing side up or down in order to protect the other side. So let's place one of Tasty Life's bread and butter strategies. This is a beautiful trade. All the back testing that Tom has done on straddles and the Tasty Life team seem to work very well. Let's go to my friendly Mr. SPX. I like to go 45 to 60 days out. Once again, we're going to February. I like to sell the expected move or the 16 delta. And here, 55.35 looks nice. I'm going to sell this put. And then I'm going to go to the expected move on the top side, the 48.80. Here we go. And here are our strikes, 48.80 and 45.35. And because I'm a little crazy, I want to see where the 45.35 strike is in our chart. So it's right here. So as you can see, I see this is a congestion area. This area might serve as a little support for our put side. And because we're at all-time highs, and 48.80 is quite up, but this market's going up like crazy. So It could go up huge. It could go up like a maniac. And our trade is only safe at the 488, 48.88 plus the $65 credit. So let's do the math. So we're going to be safe at 48.80 times plus $65. We're going to be safe till the 49.45. You know something? I might do this trade even at all-time highs. On the upside, it looks, I don't want to say that it looks safe, because nothing is safe in this world. Nothing, absolutely. There's no safety in anything. But take a look at this. We're safe until the 49, let's say 49.40. And then on the downside, we're safe at a short strike minus 60 points. We're safe till the 44.70. So I like this circumstance. Now, if you want to be more conservative, and $65 credit is too big, then you can move it. Let's say here to the 4,400, and then you can move it up to the 49.50, and then our credit is reduced to $36, and our strict value $3,675, and we increased our probability of profit. We increased our chances of making money, but we also reduced the amount of money we are collecting. So there's no free lunch, my friends. There is no free lunch. You want to be safer, you collect less money. You want to be more aggressive. Now, if you're a baller and you want to move the strikes closer, here you can collect, almost $100, and the circumstance is higher, but the break-evens are much closer. So it all depends, like I said. If you know how to trade and if you know how to set up trades, you can be as conservative, as aggressive as you want. Tweak the trades, tweak the strategies to your personality, tweak the strategies to your capital, to your risk tolerance in order to make money. Now, lastly, we have the 488 strategy. This is a complex strategy, which I will not go through in this video. I'm sorry. If you want me to go through the 488, I'll be happy to do it. I might invite one of my friends, the PM Collection, he's an expert on this, or maybe my friend, Mr. Wilson, to come in and explain the 488 trade to the group, because these guys trade the 488 like maniacs. They love the 488. It's their most beautiful and favorite trade. I like it. It has a beautiful return on capital. It's one of the highest returns on capital, but it requires a little bit more, analysis when you set it up. You have to set it up correctly. You have to meet a certain number of Greeks correctly, the theta, the delta, the gamma, the vega, the this, the that. So, it's a very doable trade. I do it all the time. But it's not a trade that I recommend for people that are not used to trading these type of strategies. Uncle Tony has it in his trading plan because it's a very important part of my trading plan, and it generates a beautiful monthly income. And lastly, if we take a look at the trading plan, we can see the cash. Right now, cash is paying around 5% on a short-term basis. I'm expecting to make a lot of money on my cash. And the beautiful thing in a brokerage account, when you deposit $250,000 of money and you put it in Treasury, they give you back 90% of that money in buying power that can be used for something else. And of course, and while you're sitting there waiting for your money, you can collect that 5%, which is beautiful. But be wary. Be wary that you don't go past your maximum planned capital, because then you're going to go into margin, and then you might get a margin call, and then you're going to start paying interest, and then you're going to hate Uncle Tony, and then you're going to say, hey, Tony, you're not as great trader as you think you are. And so that is Uncle Tony's secret trading plan. Let's review it. Once again, I like to put between 5 and 10% allocation on a different strategies. I like to have 25% in cash. I like to have a 50% initial buying power usage, $500,000. I like to be under 100% of my capital in case the S hits the fan. Excuse my language. I know this is a family show. If the S hits the fan, then I want to be under $1 million. This is what I plan to make in a very reasonable, with a very high. I'm estimating at least 70% probability that I make this 20%. And if I trade smartly, and if I trade opportunistically, and if I put trades on and take them off when the market gives me an opportunity, then I can rotate my capital. Then I can give it more turns. You know, it's like inventory turns on a store. It's like owning more apartments. Every time you can turn over your capital more times, the return on capital increases exponentially. Now, if you are a stubborn trader, you don't know the rules, you are not disciplined, you trade too big, you let a big loss hurt you, then grab this trading plan and throw it out the window, because it's not going to do you any good. It's not going to do me any good. You're going to be complaining to Uncle Tony, and you're not going to be happy. So in order to be a successful trader, in order to make money, you know, if money's paying 5%, if you're not willing to work hard at it, just put your money in treasuries, collect the 5% and be done with it. Or just buy the S&P 500, the SPY, and put it there, and then you will get whatever the market gets you. But if I want to put in the time, I want to put in the effort, I want to put my capital at risk, I at least want to make 3 times the the treasury rate. At least I want to make 15% of my money. If I'm going to dedicate time away from my family, away from the things I like to do, it doesn't make sense for me to be trading for less than a 15% target. And I think I can achieve 18 to 20% because I've done it almost all the time. Because, after 25 years of trading, I've been hurt a lot, more than any of you guys know. And I perfected my plan. I know what to do. And of course, even if you have a plan, stuff happens, life happens. And if you're small and you control your size, you control your risk, you control your capital allocation, you will be fine, because then you have enough time to let the market come back to you and, bail you out of some bad positions. So there you have it. In future videos, if you want me to go one by one in detailed strategies, detailed rules of the 111, the 120, the 441, the blah, 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 the 488, the SPY straddle, I am more than happy. If you guys want me to do it, I'll do a video of each single trade. But, these trades are not very complex, except for the 488. They're easy to set up, they're easy to manage, and they're easy to follow. And remember, if you want to grow your pile, follow Uncle Tony. Remember, these were not recommendations, these were not suggestions. I'm just showing you how I achieve that 20% return a year, how I risk my capital. And if you want to make money, remember, you gotta risk it to get the biscuit, baby.